Ever wondered why some traders consistently make profits while others struggle to break even? It's a question that leaves many scratching their heads, isn't it? Well, the answer lies in the unique challenges that the world of trading presents. Imagine for a moment the stock market as a tempestuous sea, with its waves representing market volatility. One moment, the market is calm and serene. The next moment, it's a raging storm. Traders, like sailors, must navigate these turbulent waters with the risk of capsizing if they misread the currents. Moreover, timing the market is akin to catching a fish in this vast ocean. It requires patience, precision, and a bit of luck. And just like the sea, the market is unpredictable. You might cast your net 100 times and come up empty, only to strike gold on your 101st try. Now, you might ask, how does one sail through this stormy sea and catch the big fish? Well, that's where trading strategies come into play. They are like compasses, guiding traders through the tumultuous waters of the stock market, helping them make informed decisions about when to buy or sell. One of the most effective strategies that traders use is the 50-200 exponential moving average, or EMA strategy. Why? Because it's like having a lighthouse guiding you through foggy nights. It provides a clear direction amidst the chaos, illuminating the path to potential profits. The 50-200 EMA strategy uses two key indicators, the 50-day and 200-day moving averages, to predict market trends. When the 50-day moving average crosses above the 200-day moving average, it's a signal to buy. Conversely, when it crosses below, it's a signal to sell. Simple, right? But remember, every strategy has its strengths and weaknesses. No single strategy guarantees success. It's about understanding the strategy, adapting it to your trading style, and using it wisely. The 50-200 EMA strategy, a simple yet powerful tool, might just be the solution you're looking for. It's a beacon of hope in the unpredictable world of trading, a compass guiding you towards your trading goals. So, ready to dive deeper into the world of trading strategies? Let's set sail. The 50-200's EMA strategy is based on two exponential moving averages, the 50-day EMA and the 200-day EMA. Now let's delve into what exponential moving averages, or EMAs, are and how they work. EMAs are trading indicators used to identify trends over a specific period by giving more weight to the most recent price data. This weighted approach allows EMAs to react more quickly to price changes, making them a vital tool for traders. The significance of EMAs in trading is paramount. Traders use them to identify potential entry and exit points in the market. By smoothing out price data and reducing noise, they provide a clearer view of the trend direction. Now let's discuss the two key EMAs in our strategy: the 50-day EMA and the 200-day EMA. The 50-day EMA is a short-term trend indicator providing insights into the market's behavior over the past 50 days. It's more reactive to recent price changes, making it ideal for identifying early signs of a potential trend. On the other side, we have the 200-day EMA, a long-term trend indicator. It provides a broader view of the market's behavior over the past 200 days. Being less responsive to short-term price fluctuations, it offers a more stable and reliable view of the long-term trend. Together, these two EMAs form the backbone of the 50-200 EMA strategy. Here's how it works. When the 50-day EMA crosses above the 200-day EMA, it signals a potential upward trend, suggesting it may be a good time to buy. Conversely, when the 50-day EMA crosses below the 200-day EMA, it indicates a potential downward trend, suggesting it may be a good time to sell. By comparing the short-term trend against the long-term trend, this strategy helps traders to identify potential opportunities in the market, whether they are bullish or bearish. With these two key EMAs, the 50-200 EMA strategy provides remarkable insights into market trends. Now, let's dive into the nitty-gritty of how to use the 50-200's EMA strategy in your trades. The first step is to identify the 50-day exponential moving average, or EMA, and the 200-day EMA on your trading chart. These two lines represent the average closing prices over the past 50 and 200 trading days, respectively. The 50-day EMA reacts more quickly to price changes, and thus, it moves faster than the slower 200-day EMA. Next, look for the crossover of these two EMAs. A crossover occurs when the 50-day EMA crosses the 200-day EMA. This is the point where the shorter-term trend represented by the 50-day EMA is changing relative to the longer-term trend signified by the 200-day EMA. There are two types of crossovers, bullish and bearish. A bullish crossover happens when the 50-day EMA crosses above the 200-day EMA. This is often seen as a signal that the asset's price is likely to move upwards, and thus, it might be a good time to consider a buy position. On the other hand, a bearish crossover occurs when the 50-day EMA crosses below the 200-day EMA. This could indicate that the price is set to move downwards, suggesting that it might be time to consider a sell position. Once you've identified a crossover, the next step is determining when to enter and exit a trade based on these EMAs. When a bullish crossover occurs, you might want to enter a long position. This means buying the asset with the expectation that its price will rise. Conversely, when a bearish crossover occurs, you might consider entering a short position or selling the asset with the expectation that its price will decline. However, it's not just about knowing when to enter a trade, but also when to exit. Exiting a trade at the right time can help you lock in profits or limit losses. If you've entered a long position after a bullish crossover, you may want to exit when the 50-day EMA crosses below the 200-day EMA, signaling a bearish crossover. Similarly, if you've entered a short position after a bearish crossover, consider exiting when a bullish crossover occurs. Remember, while the 50-200 EMA strategy can be a powerful tool in your trading arsenal, it's not foolproof. Every trading strategy has its limitations and should be used in conjunction with other technical indicators and fundamental analysis. It's also important to consider your risk tolerance and financial goals before making any trading decisions. By following these steps, you can leverage the 50-200 EMA strategy to make informed trading decisions. Scene script. Like any trading strategy, the 50-200's EMA strategy has its strengths and weaknesses. Let's start with the strengths. The 50-200's EMA strategy is simple and straightforward, making it accessible for both novice and experienced traders. Its simplicity lies in its clear indicator lines, the 50-day and 200-day exponential moving averages. When the 50-day EMA crosses above the 200-day EMA, it's a signal to buy. Conversely, when the 50-day EMA crosses below the 200-day EMA, it's a signal to sell. This uncomplicated approach removes guesswork and provides clear direction. Another strength of the 50-200's EMA strategy is its effectiveness in identifying long-term trends. By focusing on the movement of averages over a lengthier period, it filters out short-term market noise and provides a clearer picture of the market's overall direction. This is particularly useful for traders who prefer to ride the trend over a longer duration. However, no strategy is foolproof. The 50-200's EMA strategy also has its limitations. One of these is the potential for false signals. For example, the 50-day EMA may cross over the 200-day EMA, indicating a buy signal, but then quickly reverse, leading to a potential loss. This is why it's crucial to combine this strategy with other technical analysis tools to confirm signals and manage risk. Another limitation is the strategy's lesser effectiveness in choppy or sideways markets. The 50-200 EMA strategy excels in trending markets, whether bullish or bearish. But in a market that's moving sideways, the moving averages may crisscross frequently, generating numerous false signals and making it challenging to determine a clear trading direction. It's important to remember that while the 5200 EMA strategy can be a powerful tool, it doesn't guarantee success on its own. It should be used in conjunction with other strategies and tools, such as price action analysis and risk management techniques. Despite these limitations, the 5200 EMA strategy remains a valuable tool in a trader's arsenal. So we've traversed the landscape of the 5200's EMA strategy. We embarked on an enlightening journey, beginning with an introduction to the world of trading. Then, we delved into the heart of our topic, the 5200 exponential moving average strategy. We learned how this powerful tool is used by traders around the globe to identify potential buy and sell points. We explored how to implement this strategy, using it to our advantage to make informed trading decisions. We also took a hard look at the advantages and limitations of the 5200 EMA strategy. It's not a magic wand, it's a tool that requires careful interpretation and thoughtful application. And so, we arrive at the end of our journey. But the world of trading is vast, and there's always more to learn. Remember, the ultimate key to successful trading lies not just in the strategies you use, but in your discipline, patience, and continuous learning.